So welcome back. And if you recall, in the previous session, we did a bit of a crash course around asset classes all over the world. And just to do a very quick recollection, how markets had behaved around the world, almost like split into two parts. They behaved a certain way up till the financial crisis, and then they showed a different behavior post that. With the coronavirus and all that which has happened, we've again seen some divergences coming into markets between what the bond markets are signaling, what the equity markets are signaling. And from that, we kind of did a bit of a deep dive into the actual plumbing of the financial markets itself, and came up with two big kind of conclusions from it, or rather two big imbalances which really exist. One, which is the inordinate amount of leverage which exists in the world in the form of bonds, in the form of loans, and in the form of this humongous derivatives market called the interest rate derivatives market. Cumulatively, nobody even knows what the real size is, but it's something to the order of 15 or 20 times the size of the real economy, the real GDP, or the equity markets which we see. Which is kind of interesting because so much research, etc., is available, so much information is available on the equity markets and on the economies and all, but very little is really known about this massive leverage market across derivatives, etc., which is very much a market where only the institutions trade, and individuals really don't even get to see it. But it's really, really important to know about it because of its implications on everything we have to do with investments, just given the sheer size of it. The second big part, again, is the most fundamental part of all investing, which is currencies, because it doesn't matter what you're doing, whether you're doing an actual business or you're doing investing in any part of the world. You're first buying the currency of wherever you're doing that business or buying that asset class, and the other way around, whenever you're bringing your currency back. So it's very core to everything. And again, there's a structural imbalance in the currency markets because when they were devised, the US was a much bigger part of the global economy, and the dollar was therefore by default the chosen one to be the reserve currency. But today the US is a lot smaller part of the global GDP, but the dollar still has inordinate importance, and that creates the imbalance where everything is kind of pegged to what really happens in the dollar, how much of dollar is available, what goes on in the US economy. And since the Fed is the only institution which has the power to print dollars, it literally means that the rest of the world is held hostage to the availability of dollars at any point in time. The Fed can print money and supply dollars within the US, but outside the US, a lot of it is just dependent on circulation of dollars between various economic and market participants. That may happen at times, or you can have times like Corona and all, where all of that may get suspended, and therefore suddenly the dollars can get sucked out of the economy, creating problems. By itself, money getting sucked out is not a real problem. I mean, it can be a problem, but it can become a really big problem if you are owing a lot of debt. Just common sense on that. And that literally is the state which the world is in. So with all this body of knowledge, let's now try and project a probable roadmap for the decade ahead. Caveat that because I'm projecting a decade ahead and I am no Nostradamus, there is absolutely, there could be many, many different permutations and combinations which happen. So I would just request to pay a little more attention to the reasons I'm putting behind why I'm projecting certain things and certain timelines which I might be giving. Of course, the reality can differ from that, so do keep that in mind. But do pay attention to the reasons why I'm saying that. So if in reality, as we make our way through this decade and the reasons change, then the suitable modification on your investment trajectory can also be done. But it's very important to have this at least a probable path forward, because otherwise you're literally going to be caught blind in what is guaranteed to be the most dramatic decade which the investment world has seen in at least what we are aware of. Literally what I think is going to happen within this decade is what has probably happened over 50, 60 years. All of that may get crunched into one decade. So that's a lot. So now let's go into what's really going on. So first things first, we talked about how the Fed started printing a lot of money, which is fine, but the dollar hasn't really come down. We also talked about that. Equity markets have been going up. The bond markets have not really believed whatever is the hype the equity markets are projecting. So what really is kind of, going on over there? Now, I also mentioned how, in a situation where there's a lot of debt around, if you have to repay debt, then it is a bit of a problem trying to find money, especially if you're not able to earn the money, basic economics over there. But if for some miraculous reason you don't have to pay that interest, then you are not stretched as much. And that exactly is what has happened in the world right now. Thanks to the virus and the lockdowns and all of that, as of now, in most places around the world, there's some moratorium or the other which is already in place in terms of repayment of interest. It doesn't matter whether it's individual repayments or institutional repayments. There is a moratorium which is in place. Now, what that means is that, if you don't have money, you obviously have a little bit of a window. But even if you do have money, you can evaluate whether you really want to pay that interest or not. And that evaluation will come on the basis of what is the level of interest which you have to pay, which is the money which you would have to return, versus what is the return you can invest, you can get on that same capital if you held on to it. And if for whatever reason you're able to get a superior return on it, then why would you return that money? And that exactly is the situation one which is built up right now, where literally the market in most days seems to be going up, or let's say within a week seems to be giving more returns than what a bond, what you might be paying as interest over the course of a year. So why would you pay that anyway? So that's one. The second thing is you also need time to be able to transact in markets, to have the time instead of, having your boss look over and see what you're doing or not. So instead, we've got this wonderful work from home situation for the entire world, where you can be at home and you could be trading on the side and still, keeping your normal office laptop and everything on. And literally that time which is available makes it easier to track markets and trade markets a lot more. And I think on Zerodha, we are very, very much seeing that thing playing out. So combination of having money, having time, and also nobody really having a clue as how to value companies right now, because you simply don't know the depth of the problem right now. I mean, companies don't know what earnings they're going to make, so they can't give any projections. If they can't give projections, on what basis will analysts even analyze companies? So counterintuitively, this is actually the best possible situation, because there's any guess is as good as the other. There is no repercussion of being wrong in your projection of what the company will earn. So therefore the results don't matter literally. So you've got money, you've got time, and results don't matter. It's literally the Goldilocks period which could be there in terms of investing. And that's exactly what you've seen over the past 2-3 months, which is why this rally, and you may wonder about, it's not connected to fundamentals and all. Yeah, of course it's not, because we don't even know what the fundamentals are, to be honest. But yes, what do we have in front of us? We have money and we have time. So that's what's going on. But when does this come to an end? Now, it's impossible to really predict when sort of, what I would describe as some version of a bubble, but at what time it comes to an end is something which has made a lot of people bankrupt by trying to predict when that end will happen. But what I'll try to do over here is try to figure out when the amount of liquidity available in the hands of people may end. And the most obvious conclusion I can come up with will be, when is it likely that these moratoriums will expire? As things stand now, they are due to expire around that August-September period around the world. This is not to say that they may not get extended, they may. But the reality also is you cannot extend it too much more. Because if you do, then the people who have lent the money start facing a lot of pressure. Who are the people who've lent money? It's the banks, it's the NBFCs, it's the various, kind of financial institutions which are out there. And collectively, they're a very big part of most economies. So therefore, it is a problem if they are under that kind of stress for too long, because the potential for them going bankrupt has severe implications on the entire financial system itself. So therefore, I don't think moratoriums can extend a whole lot longer than August, September. So when moratoriums come to an end and you have to now start paying money back, that makes it a little tricky, because now there is a requirement for that money. You can't just stash it away. Whether offices open up, time available or not, that is the second part. And that's where the second issue comes, is that absent a credible vaccine, any economic activity which requires a whole lot of people to gather in one place is not possibly going to be very feasible. Let's take examples of that. Literally everything in the hospitality space is to some extent affected by this, because even when you're gathering together, and it's happening in some of the economies which have opened up as well, almost immediately the number of infections have started spiking. So what does all this involve? It involves the bars, the restaurants, the shopping malls, cinemas, hotels, airlines, any sort of transportation, any sort of public transportation really. So which is a large part of the economy, and more importantly, it's a large part of the employment generating part of the economy. Secondly, we've also seen the same issue come into factories. I mean, what has recently happened with a few, automobile factories and all that, and therefore leading to potential closures and things like that. So that again is a risk. And if that is a risk, then again, it puts a significant amount of the industrial economy at risk. The thing hasn't still spread to the rural areas, but we have to see how that shapes up. Also, since most of us have been working from home, especially on the white collar side, it's pretty plainly evident that commercial property has less use now, and we may all be rethinking, especially those of us who are in a position to take a judgment call on our business, is that, do we necessarily need that commercial space anymore or not? And the chances are many of them will reduce the amount of commercial space which they occupy, which means that, again, the owners of that commercial property face a bit of an income shortfall, or in the worst case, if they are levered, then they face existential risk. So that's, again, significant parts of the economy which employ a lot of people, which is at risk. Now, as you go to more and more developed markets, more and more people actually tend to be occupied in this part of the economy. And you can add tourism to that, which again, is probably shut for now. And that's a big part of many, especially the European economies and all of that. So if you put all that together, what it literally means is we don't really know which industries will really be viable or not. And if they're not viable, that presents the second problem, which is that in the first phase, which is what is going on right now, you've had the Fed also coming in and saying, I'm going to buy bonds. And by buying bonds, you're basically providing some support to the entire market. This has implications also because there's a specific rule for these pension funds, which are owners of assets, which is that if you have a bond which is below investment grade, then a pension fund cannot hold it anymore. So the Fed has come in and is buying these bonds to make sure that if something were to go below investment grade, the pension fund doesn't have to come in and dump it in the open market. The liquidity in the open market for bonds has reduced a lot after the financial crisis due to a specific regulation which made it very unviable for a lot of the banks to act as market makers. Market makers are people who give quotes. So, if you want to sell a bond or buy a bond, they basically offer you a quote on it. Without them, it's just very difficult to say, whether there is actually going to be, if you want to sell a bond, is there somebody out there to buy it or not? So to prevent all that sort of, falling apart, the Fed has acted as a kind of vessel to absorb all this potential sales if it happens. By acting as a sort of safeguard for that, it has also therefore helped, the pension funds avoid the need to make any distress sales. And at the same time, with all these moratoriums in place, as of now, a lot of assets have not necessarily been downgraded to junk bond status. But that may change when things actually open up and we get to this stage where the moratoriums finish. Then that may change. Certain industries may get downgraded, in terms of their credit profile. And when that happens, some of them may be a case where they may not necessarily survive also. And in which case, what exactly are you going to buy the bond for? I mean, you can buy a bond if there is a chance for the industry to survive and turn around. But if it's not there, what exactly are you going to buy it for? So that then opens up a completely different set of issues. That what do? Do you sort of bail out the industry as a whole? Do you provide like free money to the people who are employed by that industry for a particular period of time? What do you do? So Whenever you get into those kind of discussions, there's a lot of political angle to it, and therefore they are never simple decisions to take. And keep in mind that the US, which is the biggest of them, all of them, is going to go through elections during that period. So we don't know how things will shape up post the election, how the structure of their government will be, and to what extent they can take those difficult decisions or not. Now, thing markets don't like is uncertainty, and that's what we're going to be going into. So that's a phase also where if you're uncertain about whether industries survive, whether they get bailed out, whether they don't, what happens to them, then if you're a bank, you have a bigger problem. Are you going to, whatever money you manage to squirrel away right now by the liquidity provided by the Fed, are you going to lend it out, or are you going to just safeguard it because you don't know where else will the hole in your balance sheet be? And chances are you'll hoard it. You'll hoard that money to provide for potential issues which arise, insolvencies which arise in various of your lenders. Many of them are medium and small enterprises. So in that case, they're not even participants in the bond or the equity markets. Like medium and small enterprises don't even have bonds issued, or have not issued bonds or stocks. So what exactly do you have as collateral for them also? That's another issue. So keeping all this in mind, it builds up into a scenario where there's probably going to be a lot of industries which will face problems, and a lot of political decisions need to be taken, who is to be bailed out or not, and a lot of banks which will be in limbo, not really lending out money. The cumulative effect of all of this is a deflationary impact on the entire global economy. So what happens in that, also keeping in mind the high levels of debt, is that your obligation to pay down the interest in dollar terms becomes a big problem. Because if you're not generating enough revenue, how are you going to pay it? And if more and more people are in the same boat as you, then the value of the dollar will go up, because everybody will be trying to get hold of those dollars. Now, we've seen in a time where so much money printing has happened, the dollar value has not fallen. Now imagine a time, and this was a time when the dollar wasn't actually needed because moratoriums were there. But if the moratoriums get lifted and suddenly you actually start needing those dollars, and the economy doesn't recover enough to generate all those dollars via revenue and all that, then we are likely to see a big move up in the dollar against all other currencies. Initially, it will be against emerging markets because those are usually the first ones to react. But increasingly, it will be against the core developed markets, which is Europe, Japan, places like that, and of course, China as well. And that is a completely different level of order of, where this problem sort of goes to. And that's what we really have to protect against. So that's a phase where, once the dollar really starts strengthening because of this deflationary impact, is when, most asset classes face a problem, because, to meet your obligations, you'll have to sell your assets. And once any big institutions start selling assets, it doesn't take a whole long for, markets to start coming off. We saw how quickly markets turned back in January, February. So it really is, all it takes is a week of bad behavior on the part of markets, and suddenly everybody starts fearing again. So the turn can happen quickly at the time, and you could see a massive race towards trying to get hold of dollars, which creates the impact on every other currency, and in some ways pushes them further into a hole, because if they have to get dollars to repay and the value of dollars is going higher, they get further and further into that hole. So that's a problem which may take some time, maybe 15-18 months or so. But why I'm putting a fixed timeline around that is that it's also a situation which is in some way solvable by the central banks, except that instead of printing 3, 4, 5 trillion dollars, they'll probably have to print 40, 50 trillion dollars. But it will be accompanied by a fair amount of deflationary shock. A lot of that leverage which is out there in the world will have to be delevered. I mean, you'll basically have to get rid of the debt in some way or the other. Either the government buys out a lot of corporate debt, bankruptcies happen, certain debts get cancelled. Lots of action will probably happen in that whole thing, and you'll have to have a combination of debt blowing up, where you're trying to buy debt. Certain currencies may start weakening because suddenly all of that debt risk is getting transferred to the government itself from the corporate. So the currency starts facing the impact. So a lot of chaotic things can happen in that period. And as a response to that, the central banks will have to print more and more money to literally, find a way to buy up the debt and maybe even cancel the debt. I'm bringing up this topic of canceling debt a few times because that's something which can be, something which can happen. And the most likely place where I think this will happen is Japan. Japan has been the first one to start doing quantitative easing from all the way back in the 80s. They have a massive amount of debt, about 4 times the size of their GDP. However, a lot of that debt is not necessarily owned by foreigners, but some amount, of course, is. But their interest rates are very low. So increasingly, the government, and the central bank has been buying up all their debt. So you could have a scenario where they end up owning all the corporate debt, and they may just simply decide, because the rates are zero anyway, that I will cancel that debt. Now, cancellation of debt can, obviously needs cancellation somewhere else as well. I mean, it's a liability side and a debt side of an asset side of a balance sheet, and that can result in, essentially the currency almost falling off overnight. So that's something to keep in mind when we kind of work our way through this period. You could have sudden falls in currencies. That's not always bad, because it can also offer opportunities on the other side, that if you're an exporter company, the value of your company can suddenly skyrocket, especially when measured in your local currency terms. So that's an investment opportunity. It's a slightly complicated one, but something to be kept in mind. But yes, coming back to how do central banks respond to it, is literally a huge amount of money printing, debt cancellations, and things like that, which will then take us to the third stage, which is you're going to have money printing, but you're also going to need something else. Now, so far in the last decade, it's literally been a lot of money printing, which is really a financial market solution, because using that, you're buying up bonds and basically providing a support to the financial system from collapsing. But over here, we have a real world problem. We have actual industries which have gone bust or will go bust. And you have a lot of unemployment. Unemployment is a political problem, because it can lead to all kinds of, not so pleasant political outcomes. So what do? You will ideally want to find ways to generate employment. The first thing everybody will think of is trying to do infra investments. The second thing which will definitely happen is that everybody will be incentivized to bring supply chains back from China into their home countries, and it's going to happen all over. Now, whether those actions are truly beneficial over time or not remains to be seen. But it will create a scenario where you have a combination of a lot of money printing and potential future economic activity within that country happening together. And when that happens, and you happen to be, the most likely outcome is that your own currency will weaken, and because you'll be printing so much of money. So now put yourself in the shoes of, let's say, a pension fund manager in Japan or in Europe or somewhere, and try to picture what that person may do, because you can see that your currency is coming down in value, which means a lot of your assets are denominated in the currency, so that will come down in value. So what do? You'll of course go and put part of it into the dollar, which will probably go up in value, but you can't put too much into it because you have a large amount of unemployment in your country. So putting that much money there will then lead to political ramifications within your country. So you'll do some amount of buying debt in your own country, but then what else will you look at? And that's where the other things come in. Irrespective of whether an economy runs or not, you always need food. Now go back to what I also said, that the agri commodity market has done nothing over the last 40 years. No money has really gone into it. The largest ETF is only $350 million in size, which is literally like 2,000 crores. That's nothing compared to hundreds of billions of dollars for the other major commodities, ETFs. So no money has gone, means no allocation has happened. So a little bit of allocation over there, a little bit of demand, which can, come in for various reasons, because, if you think inflation and all those things will happen, the first thing you'll do is go and get food or go and buy farmland. So things of that kind can happen. And then maybe a little bit something or the other on climate change, and all of that will all get built in. And suddenly a market which has been sleeping for 40 years may suddenly wake up. In the context of all this, I think the very recent regulations passed in India of decontrolling agriculture, opening up the whole trading of agriculture, removing restrictions on how much you can own produce and all that, is very, very interesting, and something, all of us should definitely keep front and center and build it as part of our investment areas to focus on, especially in this period, probably starting towards the end of 2021, going into 2022 onwards. So agri commodities, I do see a big thing happening there. Gold again will be the other obvious beneficiary, because if there's a lot of money printing happening, there is worry that down the road there will be inflation. So gold will, start to see, and also the economies will recover. So it won't be deeply deflationary anymore. There's a little part which I missed out, and I'll cover this more in the gold session. But during the deflationary period also, gold doesn't do well, because when deflation happens, inflation is literally negative, and therefore your real rate becomes very positive. That's not a good time to own gold, because gold by itself doesn't pay any interest. So if real rates are positive, there's no reason to own gold. So gold won't work in the deflationary period, but coming out of the deflationary period, it will work very well. And a lot of allocation will start happening in that again. And to some extent, emerging market equities will also start finding favor. They might have got beaten down quite a bit also by then. The currencies might have become much cheaper by that time. So definitely, some flow will go towards that. Plus, a lot of commodity companies exist in emerging markets. So those could start finding favor. So that's the first phase. That will look pretty good, because we're coming out of a deeply negative situation and coming back to the positive situation. But then what happens after that, sort of drives the next stage, which is, remember I mentioned that the government is going to come up with various things where they want to allocate money to and generate employment as a result of which, but it may have different outcomes in different countries. Because let's take infra building, the most common thing every government would do, because it doesn't require any brains or anything to allocate to that. But what are the potential outcomes from it? Now, in a country like India, for sure, I mean, that will improve the conditions for business. It will improve productivity and everything, because literally our infrastructure is probably the worst in the world. But if you are in one of those, any of these Western countries, the infrastructure is already pretty good. The incremental delta out of doing a whole lot of infra building is really not going to be there, beyond just providing temporary jobs while you're building all that thing. But it may not necessarily create better productivity for companies and things like that. I mean, it's already pretty good. Also, they may set up a lot of factories, but again, the cost of employing somebody as a factory worker is like 10, 20 times whatever is the wage rate in, the Asian countries. And therefore, is it really going to be feasible to do that, or are they actually going to use a lot of robots and automation to do this? I think the second one is more likely. So even if a lot of this reshifting of supply chains happened, whether does that necessarily reflects in inflation on in productivity growth and per capita income growth or not is a little debatable. But what it will result in, for sure, is a demand for hard commodities, because if you're setting up factories and infra and all, you will need those hard commodities which go into building all this. Cement, steel, copper, name it what you will, they'll all be in demand. And also they've literally, again, been a bit of a non-existent part of the financial system for more than a decade now. So not too many people are invested in those places in any case. And the deflationary phase will again knock out whoever is invested in that space also. There'll be a fair amount of bust which will happen at that time, because when economies slow down, these things don't work. So coming out of it, first stage, agri works, gold works after that, and then industrial commodities start working after that. And then depending on the effectiveness of the fiscal measures and all which governments are able to put in, you either will have a situation where it tends towards hyperinflation, or it turns towards stagflation. Hyperinflation is where, there's a lot of growth, but there's a lot of inflation, prices also go up very fast. Stagflation is where growth isn't really happening, but prices are still going up. So you could have, depending on which way, how it, affects that particular economy. The second thing which will also happen, and which may be also a reason for some of the inflation in various places, is that many currencies might have weakened quite a bit against the dollar by that time. And that presents its own set of problems because some of them will truly hurt. And only when you have consensus against a reserve currency do you have a potential to change it. Now, today, there may not be a consensus to change it. Certain people may want to change, certain people may not want to change. So the dollar may stay. But if everybody is hurting against the dollar, then the consensus builds up to change the reserve system. Also, if the dollar appreciates quite a bit, it's not a great situation for the US either, because it makes it harder for them to come out of deflation, because the price fall around the world is now imported back, or is now imported back into the US. A lot of big US companies are multinationals. A lot of their earnings come from markets outside the US. But if those currencies are weak against the dollar, then once you translate those earnings back into dollar terms, then the actually earnings don't look so good. So there'll be, the confluence of demand for change, both from parties outside who are hurting, as well as the big companies within the US, the big MNCs who will also be hurting. And therefore, we may, towards the latter half of this decade, may reach a situation where there is some evaluation done on whether the current dollar system is fine or it needs to be changed. Now, that is also an exceedingly important thing to be kept in mind, both, of course, from the point of view of pricing all kinds of assets, but most importantly, commodities, especially things like oil and gold also, and even other commodities, because most of them are priced in dollar terms today. So if tomorrow, if the dollar is not going to be the reserve system, and it's going to be maybe a basket of different things and all, then big question on how you price oil, how you price gold and things like that. Now, when there is a lack of clarity on how you price something, which is, just taking the example of what's even happening today, where, there's a lack of clarity in terms of, what is the value of a company and what earnings will it make or not. And if you have money in your hands, the prices go up. So something similar to that can happen at the time as well, where there is liquidity because of money printing, but there's a lack of clarity in terms of what the value of it should be. You can see the prices of commodities going up a lot at that time and further aggravating the expectations of inflation. It will feed on itself. And when that happens, that's not an easy situation for central banks also to control, because you've just come out of a deep depression, most probably at the time. What exactly is the time when you start taking the opposite action, which is you have a deep depression, you came out of it, you printed a lot of money, but if you take the foot off the pedal or you do things like raising taxes and all that, that could bring the whole economy crashing down again, and it may not even have recovered that well in many places, because of which I was referring to stagflation. So it's going to be a tricky one. So net, when I put all this together, it's literally telling you that all kinds of movements will happen, up, down, up again. But what may go up again may be different things than what has gone up in the past. Different asset classes will come into play at different points in time. And then you have these huge, I won't even call it 6 sigma event, but like 20 sigma events, which is like possible change of reserve currencies and things like that. And how that impacts, pricing of everything. So that definitely will make for all kinds of, different permutations and combinations as we go along. And therefore, the most likely outcome out of all of this is a lot of volatility, a lot of uncertainty, and a lot of need to keep pivoting from your existing position to something else, or figuring out some, little area of expertise which you want to focus on, and not necessarily go, spread yourself too thin. So to tackle this situation, you can think of one particular way to go about it. It may not be the best way or something, but it will need some extra thinking compared to how we think today. A lot of people come and talk about all this asset allocation and all, but at its core, what is it really? I mean, we try to buy some things which will go up, and we try to buy some things which will, maybe give us some steady source of income. And hopefully these things do exist. We've already seen the steady sources of income are depleting rapidly, although we have found, quite a few things seem to be going up. So that's sort of, balancing it out a little bit. But then I refer to the point that we have a lot of changes coming up because multiple factors sort of, come into play at different points in time. Sometimes it's currency, sometimes it's deflation, debt, commodities, XYZ. So bunch of things happening. And when that happens, you have to plan for it. And that's where figuring out a strategy of how to hedge your volatility comes in. I'm sure the folks at Zerodha can, probably help you out. I mean, they've got a lot of expertise on the F&O space, so they can probably try and help you out and maybe even create products for you. We've also got certain products which kind of, help to do that. I've listed them over there. But the more important thing really is to have a plan. How to think about volatility really is that anywhere where a lot of people are allocated into, even if it is not volatile today, and there are measures of volatility like VIX and things like that, but if it is not volatile today, think of it as a coiled, a spring which is waiting to unload. It can become very volatile tomorrow simply because too many people are concentrated in it. So that's the fundamental thing you'll have to think about when planning for volatility. And then the last part is really thinking of how to hedge for inflation. A lot of people are almost convinced inflation is going to happen. I'm not in that camp. I think first we have to go through this deflationary wave because there's just too much debt in the world. If there's so much debt, you're basically going to just spend all your money repaying debt. So where is the time to go invest and create inflation? It's going to be very difficult to do that at a very global macro 30,000 feet collective level is what I'm saying. So we have to work our way through that debt. But once we work our way through it, post that there is a very high chance that policies which help us work our way through it will in fact then result in fair amount of inflation down the road. So increasingly you will have to hedge for that. The last time any serious inflation happened was back in the 70s. So none of us were really around to even know how to trade those markets. So that's why I'm kind of emphasizing on it. Resource companies and all that, many of us have never, some of us who were trading prior to 2008 would know how to trade these. Many of you may not have been trading at that time, and therefore, they kind of work very differently from how normal other companies work. In resource companies, you have to look when earnings are really bad and PE levels are very high. You have to look to buy it at that time and go the opposite route at the other time. There are a set of funds also we have which buy all these commodity companies, and that can become fairly useful at that point in time. So these are certain takeaways which I just leave you with, and hopefully all the best to navigate what is going to be an extremely interesting decade, to say the least. So that's it from my side.
Thank you, Devashish. This was very insightful. I'm sure that all the listeners had a lot of takeaways. I did. So for anybody who's listening, what we'll do is we'll create a trading Q&A post. And if you have any questions, you can just post it there. We'll end the podcast here. Thank you again.